So I just want to brag a little about our firm because we have a lot to brag about. We're very fortunate. As you know, I've been in business 28 years, helping clients for 30 years. And back in 1993, I decided that I didn't like selling mutual funds and annuities and getting paid up to 6% commission, and I needed to find a better way of working with clients. And that's when I was introduced to Charles Schwab, and I've had a relationship with Charles Schwab since 1993, formally registering Boucher Financial Group as an SEC registered investment advisor. And that's when we've been really acting as a fiduciary on behalf of our clients since then. The firm has grown. I have, as you can see, my team, we have 8 professionals that really make it happen. But what I'm most proud of is Charles Schwab does a survey with over 1,300 best managed wealth management firms throughout the country. And we are one of the top within 4% of those 1,300 plus wealth management firms recognized by Charles Schwab, and it's truly an honor. I think we're actually number 40 out of 1,300, and it's an honor that I'm very proud of, but it couldn't happen without the team that you just met. Really, together, we are here to do nothing other than make sure we meet your expectation. Recently, we were accepted into the Charles Schwab Referral Program. We are very proud of that. Charles Schwab has, it's so hard to get into this program, and we were recognized as a firm that they could trust with advising clients. So recently we became part of the Charles Schwab Referral Program. Our business continues to grow. We're close to almost $475 million, but this slide was before last week. Just kidding. As somebody says, you probably changed the presentation 10 times over the last 10 days. We, thank you for each and every one of you, because when clients give us more money to manage because they're happy with the way we're managing their money, or refer us to their family, friends, or peers, that is the best compliment that our clients can give us. And it's something that we truly appreciate. And it's because of you that we were able to grow our firm in the way we are. And as you know, I am very careful with how we grow. If we wanted to, we could have 1,000 clients tomorrow. I could open up that door and let anybody in, but that's not what we want to do. We want to make sure that we're able to give you every ounce of time that you need from us, and we're very careful with how we grow our business, and we're surrounded by very nice clients because of it. 8 professionals. All 4 of us on the investment committee are certified financial planners. Ryan is a CPA, Marty is an accredited investment fiduciary, and Harmony is studying to be a CFP as well. This is expertise that you can trust, and I can almost assure you, I don't know of any local wealth management firms that has that kind of expertise. And throughout the country, going back to that first slide, Charles Schwab says, because of all of our human capital, it's really paid off for our clients. Technology, we invest as much in our technology as we can possibly invest. Hundreds of thousands of dollars just in the last few years. Charles Schwab is so impressed with how much technology we have, and that allows us to be able to manage your portfolio, the relationship. We're able to do so much more research and due diligence on all the investments that we use to be able to provide you in your portfolios. And with our technology recently, Frank Fazio is our portfolio strategist and analyst, and he just kind of goes crazy. I mean, I can't get him out of the office. He loves to play with his new toys. He's like a kid, on one of those game things. So, we have programs like Bloomberg. Yodlee is a new program that we have where, for those of you that have 401ks at work and other outside investments outside of what we're managing for you at Charles Schwab, we're able to bring it in and keep it in one place. Mobile app coming out soon in the next quarter or so, and that's going to be pretty cool. And we're doing more with financial planning. Our financial planning integration is really just getting stepped up. So let me go over what happened last year. You know, when we were before you, we talked about a lot of things. We had a labor market and rising wages that supports economic growth for our portfolios, for your portfolios. We were overweight technology, financials, consumer-oriented names, focused on banks and the housing industry, and it really paid off for us. Interest rates and inflation expectations may rise above current levels, we thought then, so our portfolio was underweight fixed income relative to equities. And in hindsight, that was a good thing. We've been underweight bonds for a long time. You know that I say when interest rates are near zero, I really don't want to lock your money up and buy bonds that we're not getting paid on. So we've been able to find alternative assets, other ways of getting that conservative part of the portfolio, and it's paid off. We've had some nice dividends and interest that you've been able to achieve because of that, and also added to the total return. And then as the U.S. dollar strengthens and subject to higher rates and trade policies, we basically increased our exposure to small and mid-cap stocks, still overweight U.S. stocks relative to developed and emerging markets. And what actually happened last year? Equities posted their best year since 2013. Unemployment hit a 17-year low. Hourly wage growth picked up. Bond yields ended the year where they began. Volatility was just as low as it could possibly be. There was really no volatility. And we had a historic tax reform that was passed in the last half of the year, last part of the year. So 2017 was the first year in history, you heard me say that right, ever, that the S&P was up all 12 months. Boy, what a year it was. Through 2018, the index has been positive for 15 consecutive months, and that's the first time in 60 years. We've had a slow and steady rise last year. The markets did behave very well, and the best single day was up 1.38%. Nothing like that 4% last Monday when the market was down 12%. The best one-day return was up 1.38%. We had 14 months without a 3% decline. The last time we had that decline was November of 2016 when President Trump was elected our president. And we had the lowest sustained level of what we call VIX Volatility since 1995. So that was the past. Now let's get into the future, and let's talk a little bit about that big elephant. What happened this week, last week? Basically, we had a strong jobs report, and that acted as the catalyst to the sell-off that we experienced. A week ago Friday, last Friday, so 2 weeks ago from this coming Friday, January's jobs number came out. Now, we're adding jobs to the payroll. We're hiring more people. But what caught the Fed's attention was 2.9% wage growth. That means that not only are we hiring more people, I think in 2017 we hired over 2 million employees, 2 million people we put back on the payrolls. And that's pretty dynamic. But they're also not only getting a job, but they're getting a raise. And the Fed really gets a little nervous about that. Wage growth causes inflation. The more people make, the more they spend. It's human nature. And the more they spend, that drives up the price of goods and services. And that's what's known as inflation. The Fed's job is to raise inflation, put the brake on the economy when they feel it's heating up too fast. When you see interest rates go down, that's when they're trying to act as a stimulus for the economy. They're lowering rates so you go out and borrow more money, businesses borrow more money and spend more money. Well, now, as employees make more money, they're going to be spending more money, and the Fed is a little worried about that. So this sell-off really comes down to nothing other than the fear of interest rates rising. Fundamentally, the economy is doing just fine. There's no reason to worry about that. So let's talk about interest rates. We have the 10-year U.S. Treasury note. It was a low of, I think, 1.4%. Frank will get into it later. And right now we're hovering around somewhere around 2.8%, let's say. It changes every day. But this slide shows you there's a positive correlation with stocks and rising interest rates until it hits about 5%. Well, we're a long way away from 5%. We may not even hit 3% this year, but if we do, we still have a long way to go before we hit 5%. So as you can see, we are not so worried about rising interest rates. We think it's actually healthy because with inflation, with more products and services being sold, that means that corporate America will also be selling and benefiting from those additional, let's say, business that they're doing. And with technology and productivity of the workers, they're able to make more money, one of the fundamentals of the economy, which Ryan will be getting into. So let's talk about the first 18 days of 2018. As you can see, this goes all the way back to 1928. The first 18 days, we were up 7%. What's that mean for the rest of the year? On average, that means that in the first 18 days, it's actually been 8%. The rest of the year, another 1%, for a total of a 9% return for the year. We'll take that. That's on average what the stock market shows it goes up. If you go back to 1928, large cap stocks rise about 10% a year. So we'll take 9%. With dividends, it'll be up around 11%. But what I want you to focus on is the maximum drawdown is 20%. That means that when the stock market over all those years rose as much as it did, it fell 20% on average. Well, we fell 10.4% as of last Thursday night. We've regained some of that since then, but that was the drawdown. On average, it's 20%. This is another slide that shows basically volatility, the steel blue grayed out areas, volatility. And as you can see, if you go back to 2015, we had volatility when the Chinese yuan was devalued. We had it again later in 2015 when basically we lost faith in the central banks. We had Brexit, if you remember that, in June of 2016. And then obviously we have the volatility that we've seen. All of last year, there was hardly any volatility. But volatility is normal. It's healthy. Later on in the program, I'm going to go over some stats. But this is actually not a bad thing. We needed it. And as you hear me say often, we look at volatility as an opportunity. We take advantage of it. Volatility is an investor's friend if you look at it in the right way. And I think everybody has received an email or a letter from me in the last few days. Sunday morning, we emailed all of our clients and kind of shared with you what we were doing. In hindsight, it's like the Guinness commercial. We look brilliant, but that's just short term. We got a long time to go. But it was the right moves, the moves that we made. We take advantage of that volatility. Frank and I, Frank's our trader, we went in when the market was down 500 points on Friday. We put our cash to work. The market ended up being up 330 points, an 800-point swing. That's how we think. So we're not afraid of volatility, and you'll never see us have a knee-jerk reaction or panic because we look at that volatility as an opportunity to tweak the portfolios, get into areas that might have been more expensive. It's our friend, and that means it's your friend as well. And this will all pass, this volatility, so nothing to be afraid of. And then this is a nice chart for when we do have declines of at least 4%. And last Monday, when the stock market was down 1,200 points, it was about a 4% decline. Now remember, 1,200 points when the Dow is at 27,000 isn't the same as when the Dow was at 10,000 or 15,000 or even 20,000. So back in 1987, the Dow went down 500 points. That was a major correction, 23% in one day. So we went down 1,200 points. It was only 4%. So 2 days after, the market is up. 5 days after, the market is up. 10 days after, it comes back a little bit. But look at 30 days and 1 year. This is a pretty good chart, and hopefully this is what we'll experience. History will repeat itself, but I won't be able to tell you that until next year, and we look back at this. So I'm going to stop there, and Ryan's going to take over. But bottom line, this volatility isn't anything to be afraid of. And ironically, 2 years ago, I stood before you. That's the last time we had a 10% correction. It was actually almost 12%. The first 5 weeks of the year, that's when China was having problems, the price of oil, it was crazy. We opened up with the markets right after New Year's Day, and they just started going down, and they were down about 12%. And I stood before you and told you that it's nothing to be afraid of. And it's not. And little did I know that the next morning was going to be the bottom of the market. So last Thursday, I said the same thing. Little did I know the market's been up since last Thursday. So that's why I say this is normal, it's healthy, and for long-term investors, it's actually a good thing.